So if you look at CIFR Digital right now, the stock is trading around $17, which is down roughly 43% from its high back in June of 2026.
Yeah, it has been a pretty brutal slide lately, especially after they reported that massive transition gap in their Q2 earnings.
Right, and that transition is exactly what we're looking at today on Market Pulse Daily, because imagine walking into a facility that's been making you millions of dollars, right? And you just start deliberately ripping the machines out of the wall.
You're just watching your daily revenue literally plummet to zero.
Exactly. And you're doing this while carrying a multi-billion-dollar mortgage on the building. You're basically just hoping this completely new venture pans out.
It's terrifying. I mean, you are voluntarily turning off the life support in your current cash flow for, the mere promise of a bigger payout years down the road.
Yeah, it borders on reckless depending on who you ask, and that's what CIFR Digital is doing right now. They are fundamentally rewiring their DNA from a legacy Bitcoin mining operation into a high-performance computing data center developer.
Right. They're chasing that massive artificial intelligence wave. But before we get into the actual numbers on this pivot, we should probably mention our sponsor.
Oh, yeah, definitely.
So today's show is brought to you by StockOracle. It's an AI-aided stock research platform for things like fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
Which is super helpful for untangling companies like this. And you can grab a special 14-day trial using the link down in the description. Just keep in mind it is an affiliate link, so the channel may earn a commission at no extra cost to you.
Yeah, and just the standard disclaimer here, StockOracle is not financial advice. It's not a buy or sell recommendation. It's not a trading signal service or, real-time market data. AI insights and valuation estimates can be incomplete or just plain wrong, and the data might be delayed, so always verify important facts yourself.
Absolutely. So verifying the facts on CIFR Digital, the bleeding they're experiencing right now is substantial.
Oh, it's severe.
Yeah.
You really can't understand the multi-billion-dollar future they're selling until you look at the pain they're in today.
Yeah, because their top-line revenue is in an absolute free fall. Like back in the fourth quarter of 2025, they brought in $60 million in revenue.
Right.
Fast forward to Q1 of 2026, and that drops to $35 million. And then this most recent quarter, Q2, it plummeted to roughly $25 million.
Which is what, like a 58% collapse in top-line revenue in just 6 months?
Yeah, something like that. It's staggering.
And it goes back to your opening point. Management is actively decommissioning their Bitcoin mining rigs, primarily at their Black Pearl site.
They're physically unplugging the hardware.
Exactly. They're clearing the floor space and the power capacity so they can build these massive AI data centers tomorrow. But doing that just destroys the income statement today.
It really does. I mean, the Q2 earnings print was a very ugly double miss. They posted a GAAP net loss of $268 million.
Ouch.
Yeah. Analysts were expecting a loss of 21 cents per share, and they came in at a loss of 65 cents per share.
But wait, didn't management argue that a huge chunk of that, like $150.5 million, was due to a non-cash warrant remeasurement?
They did, yeah.
So walk me through that, because to a lot of people, that just sounds like a very convenient accounting excuse.
I mean, it sounds like one, but it is a real accounting mechanism. So think of a warrant like a specialized coupon, right? It gives an investor the right to buy the company's stock at a set price in the future.
Okay.
Under standard GAAP accounting rules, the company has to constantly estimate what those coupons are worth. So if the stock price fluctuates, the theoretical value of the warrants changes.
Oh, I see. So if the stock price moves the wrong way, the value of that coupon goes up, and the company has to record that difference as a loss on their books.
Precisely. It is entirely a paper loss. Not a single actual dollar of that $150.5 million left their bank account to pay for those warrants during the quarter.
Gotcha. So it kind of severely distorts the headline earnings number, making the operational business look worse than it actually is.
It does, but, and this is a big, but even if we toss that paper loss out the window, the actual cash burn is still really bad.
Right, because they are spending an absolute fortune pouring concrete and buying specialized transformers while their revenue is just evaporating.
Yeah, their adjusted EBITDA loss was still $30 million. And this brings us to a number that genuinely stopped me in my tracks when I was looking at the financials.
The debt.
The debt, $6 billion.
It's wild.
They're sitting on just over $6 billion in corporate and project debt as of the end of June. And keep in mind, their trailing 12-month revenue is just $190 million.
Carrying $6 billion in debt on $190 million in trailing revenue is it's staggering leverage.
And it's not like this is cheap debt either, right?
No, not at all.
Sure.
They funded this massive pivot primarily through high-yield bonds. Like in 2025 alone, they pulled in $3.73 billion across 3 bond offerings.
And the interest rates are rough.
Yeah, they borrowed $1.73 billion for their Barber Lake project at 7.125% and another $2 billion for Black Pearl at 6.125%.
Okay, so just doing some rough back-of-the-napkin math here. 7% on $1.73 billion is what? Over $120 million a year?
Just in interest payments on that one piece of debt.
How does a company with shrinking revenues survive that kind of daily cash drain?
Well, they survive it by severely testing the market's patience. And honestly, the market is pushing back. On the day they announced those Q2 results, the stock dropped 15.6%.
But the interesting thing is, it wasn't a sector-wide panic.
No, not at all. On that exact same day, one of their direct competitors in the high-performance computing space, Applied Digital, actually saw their stock rise by 6%.
Wow, really?
Yeah. And other peers like Riot Platforms and Core Scientific, they barely flinched. The market was surgically punishing this specific company for how deep and precarious this transition gap has become.
Okay, so if the current financials are a total bloodbath and they are drowning in $6 billion of expensive debt while revenue collapses, why on earth is this stock trading at a price-to-sales ratio of over 35?
That's a great question.
Because usually a PS ratio that high is reserved for, like, hyper-growth software companies, right? Where selling another subscription costs $0 to fulfill. It's pure profit.
Exactly.
But these guys have to build physical buildings. Why is the market giving heavy infrastructure a software valuation?
Because you don't get away with carrying $6 billion in debt unless lenders and investors see a guaranteed massive payday at the end of the tunnel.
Okay.
The market isn't valuing them based on the $25 million they scraped together last quarter. They're valuing them entirely on the future. And the bull case here is built on a very tangible physical advantage in Texas.
The land and the power.
Yes. Think of these new AI chips from companies like NVIDIA as high-performance race car engines.
Okay, I like that analogy.
Everyone is fighting to buy the engines. But an engine is useless without a racetrack and high-octane fuel to run it. They are building the racetrack, and crucially, they have the fuel pumps.
Meaning the massive electrical grid connections required to run these chips without melting them down.
Exactly. And they have actual signed contracts to prove there is demand for those racetracks. They've secured 600 megawatts of contracted HPC capacity.
And we aren't talking about speculative startups signing these deals.
No, these are blue-chip tech giants. It's a 15-year lease for 300 megawatts with Amazon Web Services, and a 10-year lease for another 300 megawatts with FluidStack and Google.
Those are ironclad, bankable contracts.
They are, and this leads us to the magic metric that is actually holding up that multi-billion-dollar valuation. Between these 3 campus leases, they are expected to generate roughly $793 million in average annualized net operating income.
Wait, nearly $800 million a year in pure operating income.
Yes. Starting in October 2026 and running continuously through September 2036. That is a decade of locked-in, high-margin cash flow.
And to give management some credit, they did actually deliver early on some of their Black Pearl capacity, right? Finishing ahead of schedule at the tenant's request.
They did, which shows they can execute when the pressure's on.
But I have to push back on the reality of that timeline. $793 million a year sounds incredible on a spreadsheet, but they have $6 billion in debt.
Right.
Those interest payments are ticking every single day. Plus, management admitted on their recent calls that they are seeing rampant inflation on labor and equipment.
Which is an industry-wide problem right now.
Exactly. So if the cost of steel, cooling units, and specialized electricians keeps skyrocketing, is that $800 million going to be enough to actually service the debt and turn a real profit?
Your skepticism is completely warranted here. The debt service alone is going to eat a massive chunk of that operating income. However, they aren't flying totally blind.
Okay, what's the safety net?
They have built a pretty significant liquidity cushion to bridge this gap. They reported $870 million in unrestricted liquidity, plus another $3.7 billion in restricted project cash.
Oh, wow. So that project cash is legally ring-fenced just to finish building out these specific sites.
Exactly. So they do have the cash sitting in the bank right now to finish the construction they've promised to AWS and Google.
It provides a runway, at least.
It does. But you are spot on about the inflation risk. If construction costs outpace their internal models, It severely erodes the actual return on investment for these projects.
So the margin for error is essentially zero.
Pretty much. Flawless execution is fully priced into the stock at these levels.
And speaking of things not going flawlessly, we need to talk about the giant existential roadblocks sitting in their way right now.
The Texas bottleneck.
Yes. So the 600 megawatts are contracted and moving forward, but their multi-billion-dollar valuation assumes they are going to grow way beyond that.
Oh, much further.
Yeah.
Their contracted capacity plus what they currently operate sits around 907 megawatts.
Right.
But the real prize, the asset that makes them a potential titan in this space, is their future pipeline. They have 4.4 gigawatts of capacity waiting in the wings.
4.4 gigawatts. I mean, just to put that in perspective for you listening, that is almost 5 times larger than everything they currently have operating or contracted.
It's massive.
That pipeline is the entire engine for their future growth. But right now, that entire engine is legally stranded in Texas.
It is. The bottleneck is purely regulatory. That whole 4.4 gigawatt pipeline is waiting on an approval process from ERCOT, which operates the Texas power grid.
This is the ERCOT batch zero approval process, right?
Exactly.
So why does ERCOT need to approve this? Like, what is the mechanical holdup here?
Well, the Texas power grid is notoriously independent, and it's isolated from the rest of the country. And, it's faced severe strain during extreme weather in recent years.
Right, we all remember those winter storms.
Exactly. So adding 4.4 gigawatts of constant, unrelenting power demand is literally like suddenly plugging in an entire major city. ERCOT has to rigorously study if the physical transmission lines can actually handle that load without triggering rolling blackouts.
So they're doing a massive feasibility study. What is the timeline for actually getting an answer?
That's the scariest part for investors. There isn't one. The decision is delayed indefinitely.
Wait, indefinitely?
Yeah. Management originally told investors they expected an answer by early August of 2026. But literally the day before they reported their Q2 results, a letter from the Texas governor landed on ERCOT's desk.
Oh, wow. What did the letter say?
It essentially halted the process. It raised political and infrastructural concerns about the grid's stability, basically telling them to hit the brakes.
So management is just sitting on their hands waiting for a politician and a grid operator to give them permission to build their own future.
Yep.
As an investor tracking this, that is the ultimate binary risk.
It's a massive coin flip. If ERCOT eventually approves that pipeline, 4.4 gigawatts of value is suddenly unlocked.
And the stock probably experiences a massive re-rating to the upside, right? Because the ceiling on their growth is totally removed.
Exactly. But what if ERCOT denies it? Or what if they just drag their feet and delay the decision indefinitely into 2027?
All while the company is still paying millions a week in interest on that $6 billion debt.
Right. Then the math gets very dark, very fast. You have a company valued as a hyper-growth tech darling that is suddenly trapped at its current size, dragging this huge anchor of high-yield debt.
The path to profitability narrows dangerously in that scenario.
It does,
Yeah.
which perfectly explains the total schizophrenia we're seeing on Wall Street right now regarding this stock.
Yeah, let's talk about the market sentiment, because the price action is incredibly conflicted. Like we mentioned at the top, the stock is trading around $17, down over 40% from June.
But if you zoom out, it's still up over 260% from its 52-week low of under $5.
The volatility is just off the charts. It has a beta of 3.21.
Yeah, and just to ground that metric in reality for everyone, the broader stock market, like the S&P 500, has a beta of 1.
Right.
So if the overall market hiccups and drops, say, 2% on a bad news day, a beta of 3.21 means this stock might violently plummet 6 or 7%.
It amplifies the upside, but it punishes you ruthlessly on the downside.
Exactly. And you see that same violent split in the analyst community. The media sentiment is incredibly bearish right now. Like, Jim Cramer was publicly on television advising retail investors to stay far away from this one.
But the analyst consensus is telling a totally different story.
They are. Across 17 major analysts, the consensus average price target is still sitting up around $32.
Wow, so they believe the stock could nearly double from its current $17 level.
Yes. However, and this is a big however, if you look beneath the surface, the psychology is shifting. Major firms are quietly walking back their optimism.
How so?
JP Morgan recently shaved their target from 23 down to 22. Keefe, Bruyette & Woods cut theirs from 32 down to 28.
So they are maintaining positive ratings, but they are nervously lowering their expectations as this transition gap drags on.
Right, but then you have this one massive wild card that completely contradicts the media panic and the analyst caution.
The insider buying.
Yes. Despite the ugly earnings miss, and despite Kramer bashing them on TV,
Yeah.
the insiders at the company are buying up the stock.
And not just a few shares either. Over the last 90 days, insider data shows a net buying of 1.75 million shares.
1.75 million.
Yeah. So how should an individual investor weigh that? You have the mainstream media and the short-term earnings saying run away, but the executives who actually sit in the boardrooms are literally putting their own personal wealth on the line.
Well, insider buying is usually a signal of deep executive confidence. It suggests that management looks at those AWS and Google contracts starting in October 2026 and believes that cash flow is absolutely secure.
They probably feel it's enough to solve their current debt crunch.
Right. And they know the ECOT negotiations intimately, so perhaps they feel confident the regulatory block will clear. But for an investor outside the building, this specific setup heavily rewards patience.
And severely punishes jumping the gun. You don't need to try and catch the falling knife here.
Precisely. It's a monitor and wait situation. You don't need to perfectly time the absolute bottom to see returns if the long-term thesis plays out.
So what are the specific catalysts you should be watching for?
First, look at Q3 2026 earnings coming up in November. You want to see if that revenue freefall has finally stabilized.
Yeah, if it drops again from 25 million down to like 15 million, the floor might completely fall out.
Second, you are watching for any official news on that ERCOT decision down in Texas.
And third,
Keep an eye out for a new large lease signing. But be warned, management has explicitly stated that if they do sign another massive contract, they might have to issue new equity to fund the construction.
meaning printing new shares, diluting current shareholders, and likely stinging the stock price in the short term just to raise the cash.
Yep. It validates the business model, but it dilutes your slice of the pie.
So, to synthesize this entire situation, they are executing one of the most daring corporate pivots in recent memory.
Absolutely.
They are taking on $6 billion in high-yield debt to rip out their legacy crypto hardware and throw everything they have at the insanely capital-intensive world of AI data centers.
And right now, their entire multi-billion-dollar future is just sitting on the desk of Texas grid regulators waiting for a signature.
It's wild. And before we wrap up with the final thought, just another quick reminder to check out the StockOracle link in the description.
Yeah, as we mentioned earlier, it's a 14-day trial. It's a great AI-aided platform for researching fundamentals and bull and bear insights. But again, it's not financial advice, and you should not use it as a buy or sell recommendation. AI tools can be wrong, data can be delayed, so always do your own verifying.
Exactly, because keeping track of complex transitions like this is exactly why you need good research tools. It forces you to watch in real time how Wall Street tries to price the massive potential of AI against the physical reality of pouring concrete and fighting with state regulators.
It is the ultimate test of forward-looking valuation.
It really is an incredible case study, and I want to leave you with a final thought to ponder that builds on what we've talked about today.
Let's hear it.
As companies across the country frantically decommission their Bitcoin setups to build AI servers, are we basically watching the physical geography of the internet being completely rewritten in real time?
Well, that's a good point.
And if AI continues to voraciously consume all the available power grid capacity, buying up every spare megawatt from Texas to Virginia, what happens to the crypto industry when there is literally no electricity left on the grid for them to buy?
That is a fascinating physical limitation to a digital currency.
Definitely something to chew on. Thanks for tuning in to Market Pulse Daily, and we'll catch you next time.